On behalf of the Faculty of Economics, as chair of the faculty, it is my privilege to welcome you all, albeit only virtually, to Cambridge for the 52nd Money, Macro and Finance Conference. Needless to say, we were all hoping and looking forward to welcoming you in person at Clare College in Cambridge. But given the current still highly uncertain situation due to the pandemic for the second year, the MMF conference had to be online. The pandemic has clearly created immense challenges for the world and the economy, and of course, also to the organizer and panel member of this conference as well. And it also creates challenges for researchers, as we will learn from a number of panels in this conference that will focus on the economic effect of these pandemics. This is what we are, the situation we are in, and there are some side benefits to it. And one of it is the number of participants to this conference is the highest ever seen. So let me use this opportunity to thank the organizer and the panel committee for their amazing work. This has been a real challenge and we are really grateful for it. And without further ado, leave the floor, or more correctly, the screen, to the chair of MMF, Paul Mesier.
Thank you very much, Leonardo. That's it's wonderful to have a welcome to Cambridge. We're very grateful to Sean Holly and his team, who've done a wonderful job in organising the conference, and to the faculty for welcoming us to the 52nd Money Macro Finance Society Conference. So, without any further ado, let me now introduce our first keynote lecture. We're very pleased indeed to welcome Sydney Ludvigson to give the opening keynotes. Sydney is the Julius Silver, Rosalind S. Silver and Enid Silver Winslow Professor of Economics at New York University and co-director of the NBER Asset Pricing Program. Most of us know her for her research on monetary policy, asset prices and asset markets, and particularly on housing prices. And she's written research papers with a list of incredibly impressive co-authors who are household names in economics and finance. Just running through the list, Mike Woodford, Renee Stutz, Lars Hansen, John Campbell, to name just a few, are really high quality co-authors and spectacular papers written with them. So Sydney's work on measuring economic uncertainty with Kyle Gerardo and Serena Ng is a classic paper that we've probably all come across, and it seems to be becoming more relevant than ever in these uncertain times. And if you haven't been to Sydney's website, I'd really encourage you to do so, to look at the data that's available there on macro and financial uncertainty, running right the way back to the 1960s and right up to June this year. Today, Sydney's going to talk to us about markets and monetary policy, drawing on her recently accepted papers and recent working papers. She'll speak for about 40 minutes, and then John Sakalis will run us through some Q&A. So there is an opportunity for all of you in the audience to make use of the Hoover platform to submit your questions, and John will select some for the Q&A session. So without further ado, let me pass over to Sydney, and Sydney, the floor is yours.
All right, well, good afternoon, everyone. Thank you. It's really a pleasure to be here, even though it would have been really nice to be here in person. Today, I want to talk to you about markets and monetary policy, and this is based on joint work and separate projects with some subset of the collaborators here, Francesco Bianchi, Martin Letow, and Sai Ma. So, the question that we have been thinking about is how and why do central banks affect financial markets? And so I think it's helpful to motivate this further by considering some stylized facts from the pre-existing literature. First of all, we know that the real values of long duration financial assets fluctuate sharply in response to the actions and the announcements of central banks. This includes the value of the stock market, which is a perpetual asset that endures indefinitely. Now, this is actually extremely puzzling from a theoretical asset pricing standpoint. And when we started thinking about this issue, we found no real existing framework for even comprehending this phenomenon. And consider for the moment that the stock market, for example, is a heavily forward-looking asset. It gives the shareholders a claim to a portion of the discounted expected value of future earnings over the infinite future. And so it is thus virtually impossible to rationalize the evidence in bullet point 1 unless something related to the central bank actions and announcements has long-lasting effects on the real economy. Now, a whole agglomeration of canonical new Keynesian models will be entirely inconsistent with this evidence, and I'll show you that shortly. And that's simply because these models imply that monetary policy shocks generate only short-lived non-neutrality. And, there's some classic empirical evidence that seems consistent with this. So then how can it be that monetary policy influences long-lived financial assets? So let's review quickly the extant empirical evidence on this. Bond markets perhaps provide the most direct evidence that long duration assets fluctuate in response to monetary policy announcements. For example, we have early evidence from Cochrane and Piazzesi, followed by others, that long bonds fluctuate, as do distant forwards. And so, I'm going to argue that there's some missing frameworks here for even understanding this, but there's some empirical evidence. One possibility is that risk premia, for some reason, fluctuate, and there's some evidence for this. These papers, GK and HS, find forecastable variation in excess bond returns, i.e. in term premia. But this is really for short horizon premia. And so that by itself can't be the whole story, as that would cause in most models, small, or almost any model that we can think of, small level effects. You really need the long horizon term premium to move, and there's no evidence of that. For the stock market, likewise, there's evidence that short-term return premia respond to Fed communications. And so we have early work by Bernanke and Kuttner, followed by a refreshing of that work in Kekre and Lanel, and something similar in Fluter and Rinaldi. Does that mean, so here these effects are highly transitory, and again, that would give us negligible price effects. Does that mean that price effects are negligible in the stock market? No. You can look at other high frequency event studies. We did one with Dan Greenwald and Josue Cox to study, the response of the stock market around the COVID crisis and the Fed, the Fed announcements around how they're going to deal with the COVID crisis. And just 5 announcements in this tight windows around these announcements in March and April led to an 8% gain in the S&P 500. Okay, so in this talk, I'm going to argue that central banks likely have larger effects over longer horizons on the real economy than the extant literature suggests. So yes, I'm going to argue that there are persistent, though not permanent, forms of monetary non-neutrality, and that these operate especially on the real rate of interest. So indeed, our model and our estimates imply, and I'll say this rather provocatively now, but I'll show you the evidence, that 2/3 of the secular decline in real interest rates since the early 1980s is attributable to changes in the conduct of monetary policy. And that's a term I'll define in a moment. And that this in turn leads to large, lower frequency changes in asset valuations and stock market return premium. Okay, so the extant evidence that I just discussed misses this because these specifications are misspecified. Put more aptly, they're incompletely specified. They miss an important part of the story, even as they may be capturing something very real. And theories that imply short-term monetary non-neutrality also are misspecified because they incorrectly focus on monetary policy shocks rather than deliberate longer-term shifts in the central bank policy rule. Now, I'm not talking about systematic monetary policy, wherein central banks respond to inflation and GDP growth, that they surely do. I'm talking about changes in the policy rule itself. So these involve changing reaction functions. The same inflation and output gaps generates different central bank reactions over time, and changing objectives. In other words, changes in the stated or unstated goals or targets absent economic shocks. So I'll just refer to these changes in policy rule as changes in the conduct of monetary policy, or sometimes I'll use the more colloquial stance of monetary policy. Now, we should note that there's a body of prior research also finding evidence of changing policy rules, and I've listed some of these studies here. There's a classic study of Clarida, Galley, and Gertler, for example. And, you know, a lot of what these studies are known for, and the emphasis is on changing reaction functions more than changing objectives. Our work will emphasize both. And, you know, the changing policy rules represent a channel of monetary transmission that is distinct from a monetary policy shock, which is an innovation in the nominal rate that's uncorrelated with inflation or GDP growth and these other shifts in the policy rule. So we think this is best thought of as a separate causal channel whereby monetary policy affects the economy rather than the other way around. After all, these changes in the conduct of monetary policy can occur solely at the free will discretion of the central bank. Moreover, they are probably shaped by the unique personalities and perspectives of different central bank leaders over time. And so let's just take a few excerpts from Jay Powell's Jackson Hole speech of August 27, 2020, when he was announcing a new framework as an example, right? So here he's saying, our new consensus statement explains how we interpret the mandate Congress has given us and describes the broad framework that we believe will best promote our goals. So this suggests that policy rules are indeed influenced by bespoke perspectives of central bank leaders. And then moving on, a clear takeaway from these Fed Listens events was the importance of achieving and sustaining a strong job market, particularly for people from low and moderate income communities. Going forward, employment can run at or above real-time estimates of its maximum level without causing concern, unless accompanied by signs of unwanted increases in inflation. We will seek to achieve inflation that averages 2% over time. So the emphasized words in these last three passages are indicative of changing objectives in the policy rule. And then finally, our decisions about appropriate monetary policy will continue to reflect a broad array of considerations and will not be dictated by any formula. So this is perhaps the most direct evidence and clearest indication yet that the Central Bank of the United States views its policy rules as subject to change. So going back to our question, how and why does monetary policy influence long life financial assets? You know, we're embarking on a research agenda. Today, I'm going to focus on the stock market. In the future, we could focus also on bond markets, but I mean, I'll have something to say about short-term interest rates. And in the first steps, and this is in the work with Bianchi and Letau, so BLL for short, I'm going to show you today some new empirical evidence for the stock market regarding the role of changing monetary policy rules, and a new framework that is consistent with the evidence that I'll show you. And, you know, this work is already completed, and, you know, I'm not in the habit of talking about published work, but in this case, it really does mark the beginning of a research agenda on markets and monetary policy that we're embarking on, and I hope that others will contribute to as well. So I think it is the appropriate place to start, and I'll spend most of my time here. Then if I have time, I'm going to talk about our next steps. And so there we'll be thinking about what news is actually in monetary policy announcements and how is it related to the evidence that I'm going to show you in the first enumerated bullet point. So this is work in progress with Francesco and Sai Ma. And here we'll be connecting to a growing literature that attempts to identify the type of news in the Federal Reserve announcements. Okay, so how and why does monetary policy influence long life financial assets? Well, one possibility is that a component of monetary policy does in fact have long-lasting first-order effects on the aggregate economy, on real interest rates, and on the stock market, even if identified monetary policy shocks do not. And so the evidence that I'm going to show you is that there are quantitatively large, decades-long joint regime shifts in asset values relative to macro fundamentals, and in the real federal funds rate minus a widely used empirical measure of the natural rate of interest, or the neutral rate, as Powell calls it, R star, which And we're going to call that difference the monetary policy spread, or the MPS, right? The difference between the real Fed funds rate and this R star measure. And so dovish regimes, which we'll define as those with negative values for this spread, this MPS, coincide with persistently high asset valuations and low stock market return premium, while hawkish regimes coincide with positive values for the MPS and persistently low asset valuations and high stock market return premium. So let's just take a look at a plot of the real interest rate and R star. And so here the real interest rate, and throughout the rest of this talk, will be measured as the difference between the nominal Fed funds rate, which is the target rate of the Federal Reserve, and a statistical measure of expected inflation. And the monetary policy spread is the difference between that real Fed funds rate and R star, where R star is the natural rate of interest from Laubach and Williams. And our sample spans 61 Q1 to about the end of 2017. So what we can see here looking at the left figure is that there is a secular downward trend in R star over the sample, as well as in the real interest rate since about the period 1980, but not over the full sample. In fact, over the full sample, this looks more or less stationary. And then, you know, if you look at the right-hand panel, here we're plotting the monetary policy spread, which has a very similar trajectory to the real interest rate itself. Now, below zero, these are what we'll call the, you know, the dovish regimes, the relatively accommodative regimes when the real interest rate is below the R star. And conversely, for the positive values for this spread, we might have expected that deviations of the MPS from zero would have been relatively transitory. Instead, what we see here is that these deviations from zero last for decades. And so what we have done here is to estimate a joint regime switching model for asset valuations and the monetary policy spread. Now, asset valuations will focus on a measure that I'll just call the log wealth ratio. It's negative the CAY, or K as it's sometimes called. This is A is household net worth. And this is, you can think of this as household net worth relative to a stationary linear combination of consumption expenditures, aggregate consumption expenditures, and labor earnings. This thing is dominated by fluctuations in the stock market because the stock market is the most volatile component in household net worth. And in fact, the log difference in A has a correlation of about 90% with a log with the return on the crisp value weighted stock market return. We focus on this because it picks up more variation in the expected stock market returns or discount rates than other stock market valuation ratios. And we discuss that in the paper. We do look at other ratios, but here I'm just going to show you everything with this log wealth ratio. So the wealth ratio has a negative in front of it. This is akin to a price dividend ratio rather than a dividend price ratio. So what we estimate is a two-state Markov switching regression system with synchronized regimes. So the MPS has a mean that shifts around with this discrete valued random variable that can take on two values. And likewise for this K or CAY. And what you can see here is that here's our estimated regime sequence or regime subperiods. The overall sample is then divided into 5 distinct periods based on the most likely regime sequence. And you know, the first hawkish subperiod, and the hawkish subperiod will be the one with a high MPS. The dovish is just defined to be the one with the low MPS. This then can take on two values. You know, that was 1978 Q4 to 2001 Q3, and this is starts shortly before Volcker was appointed in 1979, and runs until almost the beginning of the post-millennial period. By contrast, we see that the pre-1978 period and most of the post-2001 period are dovish subperiods, where the probability that the MPS regime is in the high regime is virtually zero in the posterior probability. So the hawkish regime does briefly reappear from 2006 Q2 to 2008 Q2, and this is following a string of 17 target Fed funds rate hikes by the Federal Reserve that began on June 30th of 2004 and then ended with the nominal rate standing at 5.25% on the 29th of June in 2006. And then the target funds rate remained above 4% until January 2008, when it was lowered to 3%. So if you look at this plot of asset valuations and the monetary policy spread, that's what I'm showing you here. This is the wealth ratio on the right, and this is the picture of the monetary policy spread again. And then, you know, the dovish regimes again have the low MPS, and they're in light gray, and the hawkish regimes will always be in dark gray throughout these periods. And so what you can see is this is the regime average. So these hawkish and dovish regimes, we find the MPS fluctuates around distinct means across these 5 subperiods and by quantitatively large amounts, which you can see by the axis here. Conversely, the high wealth ratio subperiods coincide with a low MPS, right? And the low MPS subperiods, the high MPS subperiods coincide with low wealth ratios or low asset valuations. Now we've labeled several events in narrative monetary history. Here you see the first occurrence of the low MPS high asset valuation regime is in the 60s and 70s and coincides with the run-up of inflation in those years. You know, a number of researchers have concluded that monetary policy failed to react aggressively to inflation in those years. And so we label this the Burns accommodation after Arthur Burns, who chaired the Federal Reserve Board over much of this sub-period. Of course, real rates shot up, and so did the MPS under the Volcker disinflation, and remained high for a prolonged period of time, right, coinciding with low asset valuations and a high MPS. And then the beginning of the second dovish period is around the year 2000, is labeled the Greenspan put after the perceived attempt of Chair Greenspan to prop up securities markets in the wake of an IT bust, a recession, and the aftermath of 9/11 by lowering interest rates and allegedly resulting in a perception of put protection on securities prices. And then the high valuation, low MPS regime continues, with the exception of this brief interlude, for basically the rest of the sample and into the time of Bernanke, with the explicit forward guidance, low for long, quote unquote, policies that promised in 2011 to keep interest rates at ultra low levels for an extended period of time, possibly longer than warranted by a 2% inflation objective. Okay, so what about, I mentioned market return premia. To get at that, we estimate statistical return premia using a Markov switching bar that looks like this. To understand how return premia vary across the previously estimated MPS regimes, we impose the regime sequence, but all of the other parameters are freely estimated. And so in principle could show no shift in return premia. And so what I'm plotting here is the whole present discounted value of a future stream of expected future excess returns on the aggregate stock market. And so that's what this is. And here we do take into account the likelihood of a future regime shift coming from the Markov switching bar in this conditional expectation. And so what you can see is that return premia fluctuate around these distinct means across the dovish and hawkish periods. Hawkish periods have high average return premium. These are the regime means for the return premium that we estimate, and dovish regimes have the opposite. Now, you can also look at the probability, the posterior probability of a decline in the PDV in the dovish regime, and that's about 81%. So statistically speaking, the data strongly favor lower return premium in dovish regimes compared to these hawkish regimes. Okay, so we need a model. We need a model for at least 3 reasons. First, to explain the previous findings, how in the world is it that the Fed's target interest rate in real terms can deviate so persistently from this measure of the natural and neutral rate of interest? Second, we want to understand how much of any of these findings are attributable to monetary policy, even in theory. I mean, after all, canonical New Keynesian models would be entirely inconsistent with this evidence. So we need to ask ourselves how to even theorize about these findings. And third, to estimate the quantitative importance of any impacts if any, of regime changes in the conduct of monetary policy on real variables, on asset valuations, and on stock market return premium. Okay, so a macro finance model of monetary transmission. I'm going to speed up just a little bit. I may skip some things to try to get past where we are, but this model has two blocks that describe the behavior of two representative agents. First, we'll have investors. For example, you can think of these as a wealthy household, or as a representative wealthy household, or a large institution that takes, it's a very small fraction of the population, but owns the vast majority of highly concentrated financial wealth in the United States, for example. And this agent, because they're small, takes macrodynamics as given. And then there are households who are workers that invest only in the risk-free nominal bond, and their beliefs are key drivers of macro expectations, inflation and GDP growth. Now, why two agents? Well, on the one hand, the motivating evidence that I just started with in this talk suggests that monetary policy has quite persistent effects on the real interest rate. And this then points to macro expectations that are subject to a fair amount of inertia. And, I'll show you why that's important. On the other hand, we've seen that financial markets appear to react swiftly to central bank communications and actions, suggesting little inertia in those expectations. So we reconcile these seemingly contradictory observations by considering a model with two agents. And the representative investor will earn income only from two assets, no labor income, stock market and the nominal risk-free bond, consumes an equilibrium aggregate payout, which will be D, or in log forms, everything's lowercase little d. So we'll assume here in this model that dividends are just some fixed capital share K of total aggregate output. And so the log SDF looks very much like what you'd expect from a constant relative risk aversion utility function. Here are some parameters. There's one exception. There's a patience shifter here. It's a time-varying specification for the subjective time discount factor that ensures that investors are willing to hold the nominal bond at the rate set by the central bank. So we have a fairly standard-looking formula for the price-dividend ratio and for the log equation, Euler equation for bonds, with the exception that there's this constant convenience yield here, and that helps us match a sizable average equity premium while ensuring that all the time variation in the equity premium is driven by investor beliefs in this model, which are crucial to everything, and they're a central focus of the paper. So investor beliefs are here, EP and VP are the conditional expectation and variance of the subjective beliefs of the investor. Now, for macrodynamics, the equations we have are very similar to the prototypical New Keynesian model that you'd see in Ghali's textbook, chapter 3. They have three Gaussian shocks, which are in green: a demand shock, a shock to potential output, and a conventional monetary policy shock. But there's three modifications. First, we allow for regime shifts in the policy rule parameters and the inflation target and these activism coefficients here. Second, we have learning and adaptive expectations. So the macro agent in this model learns about trend inflation, informs expectations about future inflation. Their perceived trend inflation will denote this way using a constant gain learning algorithm. And this is consistent with evidence in Malmendier and Nagel using survey data from the survey of consumers. Likewise, they use a backward-looking rule to form expectations for output. And, the perceived inflation of this agent does not necessarily, in fact, won't actually equal the inflation target. You can think about this, justify this as agents either don't directly observe the target and or the central bank announcements about the target are not viewed as fully credible or informative. We will allow them to receive a signal about the target, and this parameter gamma t tells us how informative that signal is. So if gamma t is very large, then deviations of perceived trend inflation from the target will be very short-lived. On the other hand, if it's low, they could be long-lived deviations. And so we'll freely estimate that parameter, and we'll be able to say something about the speed of learning in that case. Now, investors just take the below dynamics as given and form beliefs about the persistence of any regime shift in monetary policy. Okay, so investor beliefs. Investors are assumed to closely monitor central bank communications. So they actually observe when a shift in the policy rule occurs. They are uncertain, however, about how long any shift will last and much therefore learn about its duration. Now, why do we make these assumptions? Well, market participants expend significant resources on Fed watching. Central banks telegraph clearly their intentions when they seek to change the policy stance, but they are comparatively vague about how long any such change will last. And so if you look at these statements, from August 9, 2011, for example, economic conditions are likely to warrant exceptionally low levels of the federal funds rate, at least through mid-2013. And here in 2020, the committee will aim to achieve inflation moderately above 2% for some time and expects to maintain an accommodative stance until inflation expectations will remain well anchored at 2%. And so these emphasized words are murky, and they explicitly convey uncertainty about the length of time any changes will last. So here, we will model learning about the persistence of regime shifts, and this will be modeled as beliefs about whether the regime is short-lasting or long-lasting. Now, we'll also have a form of bounded rationality that is plausible, we would argue, in the presence of infrequent regime shifts. And this is a type of fading memory of past policy rules, wherein long-lasting regimes eventually come to be viewed as persisting indefinitely. So you sort of forget about the previous policy rules. Both of these things are modeled in the paper. I don't have time to talk about this here, but using the concept of perceived regimes. And so expectations 8 steps ahead are fully characterized by recursive formulas for perceived regime probabilities. And I'll get to a plot that gives you the basic idea. All right, so we estimate this model using Bayesian methods and the flat priors. Most of the parameters are freely estimated. Some have restrictions on them, but we're going to insist that the implied expected inflation process has to be consistent with observed household inflation data from the survey of consumers. So all of these Markov switching parameters are freely estimated, imposing the previously estimated regime sequence, but the parameters are freely estimated under flat priors and in principle could show no regime shift in the policy rules across the previously estimated regimes, or you could have them going the wrong way relative to the previous estimated regime. So that's all possible. For data, we use GDP growth, the Fed funds rate, the mean of the University of Michigan survey of consumers survey of inflation expectations, and this K, this wealth ratio. So what do we find? Well, big regime shifts in the conduct of monetary policy that coincide with our previously estimated regimes. So the low MPS, high valuation regimes are dovish policy rules, and vice versa for the low valuation, high MPS regimes. What's a dovish rule? It's a rule with a high inflation target and low activism on inflation deviations from target relative to activism on growth. The hawkish rule is just the opposite, right? A low inflation target and high activism on inflation deviations from target relative to activism on growth. Let me just quickly say that the model implied series track their empirical counterparts very well. In particular, we match with very little observation error, virtually none, the nominal funds rate and the survey of consumers' expected inflation. So we are basically able to completely fit the real rate over the entire sample. All right, so here's sort of a picture of how investor beliefs evolve, and you can see that what we're looking at is the probability, the left panel of the perceived probability of being in a long-lasting hawkish regime, or the long-lasting dovish regime. The hawkish is here and the dovish is in the lower panel. And in the right panel, we report the perceived probability of being in either the hawkish long or short-lasting regime, 1 quarter, 4 quarters, and 80 quarters in the future. And then we initialize these beliefs at the beginning of our sample, assuming that the agent assigns probability 1 to being in the short-lasting dovish regime. So what happens? So several years of continuously observing dovish monetary policy must pass, according to these estimates, before the perceived probability of being in the long-lasting dovish regime gets to about unity. And so that takes, almost a decade. And then in a switch to hawkish under Volcker, the agent initially places very low probability of the switch enduring. And so we see that here, like the expectation of the probability of the hawkish monetary policy regime in 1 year's time, either short or long lasting, is just about 20%. Now, this does vary depending on the history dependence in the evolution of belief. So when we, in 2006, flip back into a hawkish regime, there's a recent memory of a long hawkish subperiod, so agents will quickly perceive that returns in these jump much more. This perceived probability of being in a hawkish monetary policy regime jumps very quickly. So what about monetary regimes in the macroeconomy? So here I'm showing you the results of a simulation in which the observables and estimated state vector are taken as they were at the beginning of the sample, and all Gaussian shocks are shut down. So the only source of variation, the blue lines, are shifts in the monetary policy rule. Okay, so then we have several other counterfactuals here. No policy rule changes, or what if only the inflation target changed? And so we can see that if the central bank, for example, had not shifted to hawkish under Volcker, inflation would have just kept rising, which is not terribly surprising. Instead, the blue line, the baseline, shows that it fell tremendously. The hawkish regimes under Volcker in the pre-Great Recession contributed to sharp contractions, right here. And we get big swings in the real interest rate due to regime changes in the conduct of monetary policy. Now, if we didn't have shifts in activism, we would have had fluctuations in the real rate and in growth, real economic growth. It would have been much smaller, and inflation would have been higher. And if we didn't have any sticky expectations, inflation were to counterfactually, this is highly counterfactual given our estimates, jump to the inflation target whenever it changed, we would have no change in real interest rates or in GDP from changes in the policy rule. So the sticky expectations are absolutely central for getting anything to move in response to shifts in the policy rule. Okay, so let me just say something about the secular decline of real interest rates. We'll start with the economy in 1980, which is the peak inflation quarter, and shut down all the estimated Gaussian shocks. This is before the peak of real interest rates under Volcker. But what do we see? Well, the blue line is again the estimated movements that are purely the result of the behavior of the monetary authority, the shifts in the policy rule. The black line are the actual data. And you can see these large low frequency movements in the real rate, and most of its downward trend since 1980 is attributable to changes in the policy rule, this blue line. So shifts in the monetary regimes, in fact, explain 2/3 of this downward trajectory since the early 1980s. Okay, let me look at the time. I see that I'm probably completely out of time at this point. So I don't want to go over time. I know people probably have a lot of questions. I have a lot more things that we could talk about, but
Sydney, you have a few more minutes. You can run on for another 5 if you, or
okay, great.
So if you want.
So I'll just fly through what I can in the next 5, and then we can maybe talk about other stuff during the Q&A. So I just want to, here we can emphasize the difference between a regime change in monetary policy and a policy shock. And so what are we seeing here? Curbing inflation and lifting inflation, we have a nonlinear model. So, contractionary shocks have a different effect than expansionary shocks. But I'm going to show you the difference between in the curbing inflation case, responses to policy shocks will be the evolution of variables in response to a 1 standard deviation, contractionary monetary policy shock and no regime change. And then responses to the policy rule shifts will show the evolution of variables in response to a regime change when we start in the dovish and move to the hawkish. And then it's just the opposite for the lifting inflation case. I'm going to show you the textbook New Keynesian model. We calibrated that using the parameterization of Ludvigson and Scharfeide. And so the first point is that if you look at the textbook New Keynesian model, you see, a monetary policy shock has highly transitory effects on the real interest rate and negligible effects on the wealth ratio. This is basically proportional to PD ratio here, so you're getting nothing out of this. Now, in the BLL model that I just presented, if you look at what happens in response to a policy shock, you see smaller initial impact effects, but they persist longer. And that is due to the sticky macro agent expectations that we estimate. And the effect on the wealth ratio is larger. And so this really underscores the crucial role of persistence in monetary non-neutrality, not just the size, and that's not so important, it's how long it persists for generating big market moves. But of course, even these are not very big market moves. So now what happens if we look at the impulse responses to a shift in the conduct of policy? Deliberate shifts in the monetary policy stance have far more long-lasting effects on the real interest rate and thus larger effects on asset valuations. And we can discuss why that is later if you want. But effectively, the central bank is not trying to actively stabilize these shifts. And so they can have much more long-lasting effects. The only thing that matters is how quickly macro agents form expectations and adapt their expectations to shift in the rule. And because we estimate a significant amount of inertia consistent with a survey of consumers and macro inflation expectations, changes in the conduct of policy have effects that can last for decades. I should emphasize these are very long-lasting effects. So if you now look at the monetary policy, how monetary policy affects asset valuations over time, this is what we're plotting here. Again, the data is in black, and the regime means are in blue. And now I flipped the colors on you. The red dashed lines represent fluctuations due solely to regime changes in monetary policy under our baseline model. So we can see that the model implied values fluctuate closely around the data means for both the wealth ratio and the monetary policy spread. The large swings in asset valuations coincide with persistent changes in discount rates due to changes in conduct of monetary policy. And notice that learning about the persistent delivers a more gradual adjustment of valuation ratios after a switch. And so you see that here and you see that here. And so that's important for getting that aspect of the data right. Okay. So let me skip and show you the market excess return. Monetary policy does affect the market excess return. So here's the data estimate of the PDV of expected future excess returns that I showed you before. And this blue line is just the component from the model of real interest rate variation that is attributable only to changes in the conduct of monetary policy. And that positive co-movement between the PDV and between the real interest rate, we call that the component that's attributable to monetary policy is RIR NPR is quite strong. So the dovish policy is associated with low return premia and the hawkish policy, high return premia. And the correlation between these two lines is 81%. Now, the correlation between the residual part of the real interest rate variation is 9%. Since we're matching the real interest rate variation without error, what that's telling us is that our estimated deliberate shifts in monetary policy play an important role in this co-movement, but changes in real interest rates due to other shocks in the model do not. Okay, so the last thing I'll show you is how do we get to this expected return variation. That's where the fading memory distortion comes in. It's a form of over-extrapolation. Suppose investors haven't seen a regime shift in a while and they come to believe that the current regime will persist indefinitely. In reality, regime shifts are persistent but not permanent. This is a form of over-extrapolation from recent events that has some precedent in the literature. And so what that means is that, an econometrician would in fact, armed with historical data generated by this model, would in fact be able to detect overreaction and find predictable changes in return premia across these monetary regimes. And so this figure here shows you that. This is from a simulation of the model 20,000 times. And then we average across all the Gaussian shocks. And what I'm showing you is, our averaged PDV from the model, do it exactly like we do in the data. And at each point in time, we average across the wealth ratio from the model and the real interest rate from the model. And so the observed movements in these variables are attributable solely to regime changes in the policy rule. And so what you can see is the high PDV regimes, PDV is high when the wealth ratio is low, right? And the real interest rate is high. This is the real interest rate attributable to monetary policy and vice versa. And the probability of a decline in the PDV in the dovish regimes is about 73%, the posterior probability, and this compares favorably to what we found in the data. So Paul, let me just stop here if that's desirable. And I was going to talk about the stuff we're moving on to next, but if people have questions, I'm happy to talk about that, or just take questions on what I've talked about.